Scott Bauer is joining us, CEO of Prosper Trading Academy. Scott, I want to get your macro take, but let's talk some of these payments for a sec. Right now, there is a question, of course, about how quickly we come back. In fact, Jay Powell just said he expects a pretty sharp rebound once the coronavirus goes away, but we don't know really when that's away and what kind of economic situation unfolds over the coming months and weeks. Do you want to get exposure to some of these very direct consumer spending plays like payment stocks?
Actually, not right now, Oliver. I still think it's way too up in the air over what happens in the next week, next 4 weeks, next 8 weeks. If I could give you a longer-term horizon for a year from now, yes, I want to be long every single one of them. But as a trade, as a near-term, I don't even want to call it investment, but as a near-term position, I'd probably rather lean to the short side than to the long side.
All right. How would you go about doing that? Because this market seems like it has right now something up its sleeve, Scott. It's just every move. Even before the Fed, we were rallying all this bad data anyway, so it seemed like stocks were expecting maybe a faster recovery than some of the economic expectations.
Sure, no doubt about it. But I look at a stock like MasterCard, in the payment space here, and in all of these, MasterCard, Visa, PayPal, they've all had incredible rallies since the bottom a few weeks ago. MasterCard is up about 40% since the bottom, and it's very difficult in general, macro-wise, to look at technicals in the market right now just because of the volatility, because of the gyrations that we've had. However, if you do in MasterCard, okay, look just above where we're trading right now. Right around that 280, 283 spot, Oliver, we see a lot of resistance, right? You've got the 50-day, you've got the 200-day moving averages just above where we're trading right now, which temporarily, short-term, would and should provide some level of resistance, some big level of resistance. So I'm actually looking for a retracement right now. Again, if I was going to have an investment for a year from now, I'd want to be long this. But as a short-term trade, I want to take advantage of what's out there right now. So when I look at this, and I'm going out a couple weeks here because I don't want to get into an earnings cycle type of trade. So my trade in MasterCard goes out a couple weeks to the April 24th expiration. And many of your listeners know what a butterfly is, a butterfly spread. And I'm going to do a put butterfly. However, this is called a broken wing butterfly. The reason being is the strikes that I'm using, the width in the strikes of my long side of the spread is much wider than it is in the short side. And that's what gives me this big downside bias to this type of trade. So what I'm doing is I'm buying the April 24th 260 strike put. I'm going to sell 2 of the April 24th 250 strike puts. So I have a $10 wide long put spread. But then I'm going to buy as the bottom level there, 1 April 24th 247.5 strike put. So I have a $10 wide long put spread and only a $2.50 wide short put spread. Now, the reason I'm choosing those strikes, Oliver, is because right now, the approximate market maker move that is being priced into the market is $23, $24. That puts us right about at a 250 target a couple weeks from now. So I want that downside exposure, and I can do this really cheap right now. I can do this for under $2, probably about $1.75, where with a maximum potential here that this thing goes to $10. So if I'm wrong, if MasterCard, if the space continues to rally, okay, it continues to rally. All I can lose is what I pay for this, but it gives me incredible downside exposure in the near term.
I like it. Scott, really interesting here. 3 parts to the trade: selling puts, buying puts, looking for the skew to the downside on a pullback for MasterCard right now, trading at 271, little changed on the day. Important to note that MasterCard and these credit card companies are in the tech group, and right now tech is curiously lagging a day in which investors are running to some of the bond proxies, but then they're also running to banks. So we got a really interesting session here. I have no idea how this is going to play out in response to the Fed. Maybe people are just liquidating tech so they can buy high yield bonds. Scott, Big move by the Fed this morning. I just want to get a real quick thought from you. We're going to talk some macro in the next block as well. What do you think? I mean, do you have to be risk on an environment where the Fed is doing what they're doing?
I'm very skeptical, Oliver. I'm very, very skeptical because on paper and on headline, it sounds great, right? They're doing everything they can to backstop the economy, to backstop the small business, which is a great thing. However, at some point, and I'm not smart enough to know what that is, whether it's a month, 6 months, whatever it is, at some point that's going to come back, and we're going to have to make this up. So on paper, it sounds great. And many of, personally, my family members own small businesses. They're taking advantage of this, which is great. But for the macro look at the economy, longer term here, it's do whatever we can right now to get the economy going again, and then decide, how we're going to deal with it later on. I don't like that setup.
Yeah. All right. I like it. Scott Bauer, straight talk here. Appreciate it, Mr. B, CEO of Prosper Training Academy. We're going to discuss some more of how all these moving parts fit together in a